we are going live in 3, 2, 1.
Okay. So, good morning to everybody. I think we've got people joining us now, so we'll leave it for a few seconds to wait and see for everyone to join us, and then we'll get cracking with this webinar. I'm delighted to welcome you all, those of you who've joined us so far, and we'll proceed with the formal proceedings just as soon. I can see participants logging on, so I don't want to get going too quickly until we've got a good number of people. So welcome to everyone who's logging on. That's fantastic. Nice to see you all. This is the ILC's weekly webinar, Lockdown Not Shutdown. We're looking at the myths and realities of spending in old age, and we'll be virtually launching our report here in this webinar today. And again, I'll just leave it for a little while longer to see how many more people are going to join us before we get going. Lovely to have you all along. Thanks for coming. Okay, so looks like we've got a good number of people. So let's crack on because there's a lot to get through and some really fantastic people to hear from. And I look forward to you all joining in the conversation and logging your own questions as we go along. So thank you again for joining us for our webinar and virtual report launch, Lockdown Not Shutdown, the myths and realities of spending in old age, which is co-hosted with the Phoenix Group and supported by the ILC's Partners Programme. I'm Diane Kenwood, I'm a trustee at the ILC. And before we get started, there are just a few housekeeping rules that I need to go through with you. So there's the usual note about any internet issues that may potentially affect sound and video. So I'm really hoping that's not going to happen to either me or any of the panelist participants, but please do bear with us if they do, and we'll try and sort them out as quickly as possible. At the bottom of your screens, you'll see a chat function, which you can use to communicate with the panelists and delegates. Do note that there are various selections of the people you can talk to. So you can either choose to chat to everyone, or you can choose individuals to talk to. And there's also a Q&A feature at the bottom of your screen, and that's where we'll be collecting your questions as the webinar goes along. So please do put your questions up there. And if there's a question you particularly want to have answered that someone else has asked, click like, and that question, the more likes the question gets, the higher it raises up the ranks. So we'll be absolutely sure to get through the ones that are really popular. If you are having any issues with your audio or video throughout the webinar, try connecting through an Ethernet cable or through a hotspot on your phone. And if you do get disconnected, you just use the same link from the confirmation email you were sent to rejoin us. We'd love you all to post comments on Twitter. And if you do, please use the @ILCUK handle and the event hashtag, which is hashtag longevity dividend, capital L, capital D. So also to let you know that this webinar is being recorded and it will be published for public access on our website, and we are currently live streaming it to YouTube. And, you know, please note the exit doors, the closest one of which may be behind you. I think that's all the housekeeping we've got. So coming out of COVID-19 with a functioning economy relies on us better engaging with older consumers. The wealth and spending power of older people is significant. So spending by older consumers is already worth 319 billion and may increase to as much as 550 billion, or 63 pence in the pound, by 2040. Yet, older people are underspending. In 2015, ILC research found that retirees were saving 48.7 billion per year. The new ILC report, Lockdown Not Shutdown, seeks to explore the main reasons why spending falls in old age. It makes a series of recommendations targeted at policymakers and the industry to ensure we maximise the longevity dividend. Author of the report, ILC Director David Sinclair, will present the key findings to you, and then we have a panel of fantastic sector experts who will proceed to respond. And then we want to hear your views on what works and doesn't before launching into our Q&A session. So please do, again, I want to remind you, submit your questions to our speakers using the Q&A feature. That's down at the bottom of your screen. And join the conversation on Twitter using @ILCUK and hashtag longevity dividend. Right, let's crack on and hear this report then. So I'm going to hand you over in a second to ILC Director David Sinclair. For those of you who don't know, David has worked in policy and research on ageing and demographic change for 15 years. And he has a particular interest in older consumers, active ageing, financial services, adult vaccination, and the role of technology in an ageing society. He has strong knowledge of UK and global ageing issues, from healthcare and pensions to housing and transport, and he has presented on longevity and demographic change across the world. So David, over to you.
Great, thank you very much, Diane, and thanks all for joining us. I should say, when I started working in ageing, I had lots of older people who come up to me and say that I was far too young to be working in ageing. That doesn't really happen anymore, sadly. At the same time, when I was younger, I didn't have grey hair. Of course, now I have, but I'm obviously going through my midlife crisis with my blue. So I'm just going to talk about this report, which started off as a bit of a rant and was going to be a blog around a sort of set of arguments, which I hope are evidence-based, around why spending falls in old age, and particularly given, very relevant this week, given the relaxation of lockdown, but also the government's announcements on a new deal. You know, I just really wanted to explore some of the arguments made about why spending seems to fall as we get older. So the three key points I'm going to be making are, firstly, you know, older people are sitting on average on significant wealth. Secondly, yes, they're spending a lot, but we have what economists call a retirement consumption puzzle. And this happens in the UK, but it also happens in places like the US and Japan and Korea. And it's basically where, for some reason, as we get older, we spend less money. And, well, you know, the whole purpose of this discussion is to sort of explore some of the reasons why that happens. And then the third argument we really want to make is addressing these barriers will actually play a key part in kickstarting the economy post-COVID. So one of the things that one of my colleagues is often challenging me about is, you know, why does this matter? You know, actually, you know, we're interested in aging, we're interested in older people, you know, why is consumption important? So he made me think about it. And I think fundamentally, there is the obvious. Consumption drives economic growth, extraordinarily important. But also, consumption plays, you know, is vital in terms of satisfying our needs and supporting meaningful activity. If we want to move up from food, water, warmth, and rest in Maslow's hierarchy of needs, actually consumption plays a big part in helping us get to self-actualization. I think the thing we want to flag at the start as well, though, is that, and we had a section in the report which I called at one point, we want to make sure that, you know, people aren't just buying bits of tat. And I think that, you know, clearly, as we're interested in consumption, what we don't want to do is create this environment that says older people have got lots of money, they should spend it on sort of environmentally and socially unsustainable products and services. So I think part of the argument has to be is, how can we ensure that the sort of products we're creating for all ages are more environmentally and socially sustainable? So running quickly through the evidence, we know that older people are already spending significant amounts as consumers, 54 pence in the pound. This group and the growth you'll see from the figure one on the slide is driven by two things. One, an increasing number of older people, and actually also these over 50s in this case spending more per head. I also wanted to flag this thing around dementia, because this is one that often, I just wanted to highlight the diversity in the older population. Clearly, so 80% of people with dementia list shopping as one of their favorite activities. Yeah, actually those older people spending that £319 billion a year and beyond actually are extraordinarily diverse in their backgrounds of issues, desires, and so on. They're almost certainly not on the cruises nor in care homes. What we also know is spending could drive costs. Our analysis from last year showed that we could potentially add 2% a year to GDP, and we could, spending alone could potentially address some of the age-related fiscal costs. But what we also know is retirees underspend, and the work that we did back in 2015, 2016 showed that spending from the age of 55 falls by about 1% a year. So there is significant wealth, there is significant spending, but there is also an underspending relative to wealth. And as I said earlier, I think the reason we wanted to do this today was because with lockdown relaxing, the hospitality sector really needs older people. I have to say, I think the hospitality sector often denies it needs older people. The nighttime economy, whether that be pubs, cinemas, hotel chains, absolutely rely on older consumers, yet they often pretend they don't. Our analysis showed this sector is one of those sectors where demand from older consumers is going to grow over the next 20 or 30 years. And I've chosen Premier Inn as an image there because I think actually Premier Inn and Whitbread do this pretty well. A fairly age-neutral product, includes junior hotel inspectors, but they also have some pretty smart age-neutral advertising, inclusively designed products. I'm not advertising, but I think that I just want to show that it is possible. So running very quickly through why we think it happens. First point to make is that our health gets worse. This is one of the biggest reasons why spending falls in old age. You get to a point where it just becomes too much of a hassle to get and go in the back of a plane to do a long haul or even short haul flight. Our health makes spending less attractive and more difficult, and the IFS have highlighted the relationship here, but our work has also done this. This photo actually is from Macau, and a place like Macau, you have entire shops designed to sell sort of preventative health interventions, some of which are good, some of which are a bit bad science, but actually it is interesting that you're starting to see this market around prevention. I think extraordinarily important as well. Second point to flag is, and this again I think is really important, particularly for the financial service industry, is we just don't know how long we're going to live, and that results in precautionary savings. We save money for the rainy day, and that rainy day never comes. I took yesterday or the day before my life expectancy from the ONS. Apparently I'm going to, my average life expectancy is 84, but there's a 1 in 4 chance I will live to 93. Now, how can I plan my finances when I might live to 93 or I might live to 84? It's extraordinarily difficult, but it is important that we are more aware of how long we might live. Another factor I just want to throw in here, which is coming out of some qualitative work we're doing at the moment, is that the extent to which we think we might need to pay for care in the future does seem to be having an impact on, again, spending. And again, IFS have picked this up as well as our qualitative research recently. I think I've been originally very skeptical about this on the grounds that most of us don't think we'll need care, and most of us don't know that we don't get care for free. But perhaps there is a point where all of a sudden we realize that there may be a care cost we have to pay, and that is impacting upon consumption. But that might be something we want to come back to. Another factor that people talk about in terms of why they stop spending is that they want to leave money or give money to other people. The reality is that people don't gift during their lives huge amounts, or the amounts gifted by grandparents is relatively small relative to wealth, and of course 1 in 5 of us doesn't have children. So this may or may not be a reason, and I think there are interesting implications around things like inheritance tax here, and whether or not that incentivizes or disincentivizes giving or spending during the life. I think one thing we're flagging is actually when we did our work on grandparents a long time ago now, one of the reasons why some grandparents gave money prior to leaving a legacy is they liked control, in that actually once you're if you are in a place where you can say to your grandchildren, you can have this £2,000 or £3,000, but you've got to spend it on your education or on X or on Y. You have a degree of control. You have a lot less control about whether your grandkids spend the money on sex, drugs and rock and roll after you've died. And there's quite an interesting sort of question about whether or not that as a motivation for giving, which we might want to explore. I think this another point is that we don't need or want as much stuff as we get older. We know two issues here. One is that we know work is a massive driver of spending. Those of us, and all of us who've been in lockdown, you know, if you're no longer buying cups of coffee, if you're not buying shirts, if you're not commuting, if you have lower childcare costs, actually when you stop work, spending falls pretty dramatically, because actually there are work related costs that people have. So actually supporting working longer has a double benefit in terms of income for individuals, but also supporting consumption in the economy. I think the other piece, which I don't think there's very much research on, I certainly haven't seen very much, is that as we get older, perhaps we just, you know, we've just got enough crap. You know, we've got enough stuff. We've got enough fridge freezer. We've got our new garage door. we get things done. And as such, some of the consumer products that people attempt to sell to us, actually, we're just not that interested. Now, I don't know if this is true or this is my own ageism. I think it's an interesting thing we could delve into, whether or not actually that is true. And if so, do we need to be investing a little bit more in services than products, concierge services, interesting things to support us to be independent and build relationships rather than more tat. So I don't know if that's true or not. What I do know is we spend a lot of time watching television as we get older, but actually the relatively few of us buy premium packages or indeed services like Netflix and Amazon as we get older. So there's a really interesting contradiction there. Another issue as we get older is actually just getting to and around the shops. People enjoy going to the shops. If it becomes physically difficult, if there are no toilets, if the shops are noisy, if there's a fear of crime, it just becomes a little bit too hard. If you've fallen over, massive reduction in falling confidence that makes physically going to the high street difficult. We know that from the English longitudinal study of aging that most of us say don't go out as we age, don't go out as much as we like, but they'd like to go out more. I think yesterday I saw the government have announced a relaxation of the law, or would be, in relation to scooters. One of the really, and I'm fairly enthusiastic about the potential of e-bikes and scooters and things like that to support people, segways, although they're about to stop production, to support people to move independently around the high street. And I think the regulation has not supported innovation in this space, and I suspect there is an unserved market for older people for scooters, and but we will see. There is another argument that we can't find products and services. I'm not as this is a challenging one, because for me the question is, do we need a specific product that is a product for older people, except for products which might be specialist projects or products or disability products, and I think in the main we don't. I'm often getting people calling me or emailing saying, I've got this great idea for the product that does what, and I'll often say, have you Googled that? Because normally it already exists. But also the question around whether you know, to what extent we need age-related rather than inclusively designed products. And the reality is, even if you come up with the most brilliant product targeted at a 55-year-old, it's really difficult to sell that. And Isabel might talk about this, because we all deny aging. So how do you market a product to someone around age when actually age is something we deny? TripAdvisor are there because actually I think that what we don't need is, you know, and you see ideas for this all the time, you know, a TripAdvisor for older people or disabled people. Actually, we don't really need that. We just need TripAdvisor to have a tick box that says whether a hotel room's got a shower or a bath. You know, we need mainstream products and services to offer the sort of things that people want. I do think things have changed in this space. So if you look at the millions and millions of pounds that Amazon have spent on redesigning packaging, you know, the Ford Focus stuff around redesigning of the Ford Focus was done in the 1990s, so 30 years ago now. The OXO good grips, you know, good quality design is actually a lot more mainstream than we sometimes give credit for. But I will just touch for a second on disability or specialist products, because, you know, one of the things people say is, you know, when you're looking at that market, you know, they're all so ugly. And you know, I struggle a bit with this because actually they're clearly not. Again, a quick Google, you find some beautiful examples of disability products. So I thought I'd delve a little bit into the reasons why some of these don't come to the market. And the image on the right is one that the Helen Hamlin Centre School of Design have published, but there are lots of examples of really attractive disability or specialist products to support us as we age. First point is the person using the product isn't the person buying it. It's sometimes a son or daughter or an occupational therapist who comes and doesn't realize the need. So actually they buy the first thing they see, or they're actually what they think that the person who wants the product, who needs the product, needs is not actually what they need. Second thing is that actually some of the most attractive products actually aren't very usable and inclusively designed. So actually might look beautiful, but it doesn't work. Thirdly, even if they do, if you're an occupational therapist or a physio or someone who wants to recommend a product, you know, you'd be pretty terrified about recommending a product you didn't know worked. So, you know, someone comes in, you need to give them a wheelchair or a adaptable kettle or, you know, whatever it happens to be. You're going to be really, really focused on something you definitely know works. You're not going to want to open up risks. So we need to make sure that people are, you know, the newly designed products, you know, that we support people who are buying them to have the information that they actually work. I think the other couple of points is we buy these products at the point of crisis, so we don't have time to shop around. We don't go to John Lewis or IKEA for the bath rail, because basically what happens is someone falls over and they need an intervention immediately, and you just don't have time to do it. So actually we don't buy them in advance. And then I think finally the attractive design products sometimes cost more, and sometimes significantly more as well. So I think there's an interesting diversion we can go down there. I'm not going to say very much about this because I know Isabel's going to talk about this, but you know, the extent to which the PR advertising marketing industry just doesn't get aging is extraordinarily important. And I started off writing this by coming to the defense of the PR advertising marketing industry on the grounds that I think, you know, there is significant awareness in parts of it around the need of older consumers. I think that there is an argument that the smart advertising industry and marketing industry realize that, you know, we're all a little bit ageist and we all aspire for youth, so therefore you look to imagery of youth. So I started off really positively, and I thought, you know, this doesn't exist anymore. You know, the examples we used 10 years ago, you know, don't exist. And then I saw this on Twitter, the image on the right, which is just the most obscenely ageist image I've seen in years of, you know, the difference between what, you know, a 49-year-old and a 50-year-old woman looks like. And it's worth reflecting, women in particular can be particularly badly portrayed and stereotyped by the industry. So I started off being a bit positive towards the industry, but KETO have undermined that a little bit, but Isabel's going to talk a bit more about that. Age discrimination, extraordinarily important, although perhaps less so than it used to be. We now have age discrimination legislation for goods and services. I think direct discrimination, there is a lot less direct discrimination than it was. I think we still have a situation there in the image on the right. If you Google buying a mobile phone, it's often smiley young men and women in their 30s in shops. You know, the imagery we're using is in some ways indirectly discriminatory and says the sort, you know, is giving a message. I think the other point here is that actually, you know, if companies are offering products which are exclusively online and half of those aged over 75 aren't regular internet users, there is a degree of indirect age discrimination here. There is, coming to the last couple, one issue is one argument is we don't have enough money. And I think, as I started, I think over-saving remains a bigger issue than overspending. The reality is governments of all colours over the last 20 years have been fantastically successful at helping reduce the likelihood that we are inevitably poorer in old age, whether that be through pension credit and then policy initiatives since then. I think the end of DB pensions, though, we're about to see an increase in pensioner poverty, so things might change. But I just flagged this photos from Hong Kong that I took last year, where on the one hand you do still have very significant across the world differences in wealth. You have the horse racing and the wealthy gamblers going around the Hong Kong race course, and then 10 minutes later you have the men in their 70s, 80s, 90s who are clearly very low wages, working in either in the middle of the sun or the middle of night to do work because basically they're fairly poor. So I don't think money is the same barrier as it was though. And then I think finally, and I've touched on this, digital divide remains a bit of a challenge. And I will perhaps also flag in relation to COVID, the questions image there from my local Costa, who's just opened but only accepting cards. There is undoubtedly an issue with age and use of card payments and electronic payments. And I think whilst I actually think this is inevitable and the end of cash will happen, I don't think we're particularly preparing either older people or preparing retailers and others and government indeed to support this, to support us all to make the move. So finally, what needs to happen? I think three main points and then a final comment. Firstly, I think we've got to invest in preventative health. Health undoubtedly impacts on our likelihood of spending. If we can reduce the likelihood for a couple of years of how long we are ill for, this could have a very significant impact, not just on how long we work, but also how much we spend. Products and places, age-friendly cities, age-friendly, we've got to get a bit smarter about designing products and places. And then actually we've got to find a way of supporting people to understand how long they live, create the right sort of financial service products that allow us to have confidence in spending. And then, particularly relevant this week, given the Prime Minister's announcement, I think, and the Prime Minister made an announcement of about £5 billion of investment. I think we would argue that actually, if you look back to Roosevelt's New Deal, that actually it was financial investment, but there was also regulatory, legislative, other fiscal incentives. And I think in an aging society, we do need an aging society New Deal that goes beyond a bit of an investment in some products and services into a much more holistic approach to how we respond to aging. So I am going to stop there, but thank you, Diane.
I'll try unmuting myself so you can actually hear me. Thank you so much, David. That's fantastic. There's a massive stuff in there, and I can see there are beginning to be questions coming through. So please do post your questions in the question tab at the bottom of your screen, because I'm now going to invite our three fantastic panelists to give their responses to the report and what you've just heard as being the highlights. We're really delighted to be able to welcome them here to this webinar. We've got the Right Honourable Lord Willits, who's the President of the Resolution Foundation, Jenny Holt, who is the Proposition Director for the Phoenix Group Life Companies, and Isabel Smingen, who's the Deputy Dean and Professor of Marketing at the Birmingham Business School. So I'm going to invite each one of them to give their responses in turn, and then we'll open it up to all of you for questions and answers. So don't forget, keep posting your questions in the Q&A tab. So let me start with you, Lord Willits, and over to you for your responses and thoughts on what David and the report has said.
Well, thank you very much indeed. I thought it was an excellent report. And let me offer some broad comments and then turn to the specifics. I mean, first of all, overall, you would expect me, having written my book, The Pinch, about fairness between the generations, to point out that the starting point of David's analysis is just that this older generation have growing incomes and wealth, and good for them. And I'm a beneficiary of this process. But sometimes I get the pushback from my argument, well, you know, old people aren't affluent and I'm painting a caricature of them. This is a reminder that there is a lot of income and wealth in that older generation, and the challenge is how to ensure they consume it. First point. Secondly, I would set this in a kind of framework of economic theory, which is the whole kind of life cycle hypothesis. This is the idea that we spread our consumption across the life cycle. It doesn't exactly match our income. There's a time in middle age when we are saving a lot and so spending less than our income, and a time in old age when we are dissaving and spending more than our income. And the idea is that in the perfectly planned life, you end up on your last day drinking as your mortgage on your house hits 100%, when your money has run out, sipping your last martini. And on this basis, any money that is left over is a mistake. You could have spent more. And David's analysis is fascinating because, of course, it does show 10 reasons why people might be continuing to save on a really extraordinary scale, up to £50 billion a year, he suggests. And I think the third point I wanted to bring out generally on the generations is a challenge that you sometimes hear levied at younger people, is the reason why their living standards are on average quite low is because they're spending all their money. And that you know, they're the people who are eating out, they're the people who are going on expensive holidays. If anything, the evidence is that young people are living quite frugally, constrained by their incomes. And although David wants older people to spend more, they, as he himself has just said, already an important part of the modern consumption economy. They're heavy users of dining out. They're very likely to be traveling abroad on holidays. So they are already shaping a market. They're already big consumers, even if some of the marketing agencies, as we saw in that shocking image, haven't yet completely caught up with that. So we're fundamentally talking about old people who have, on average, got quite a lot of money. There are always exceptions behind the averages. But in the work we did at the Resolution Foundation, we showed that if you look at the poorest 20% of pensioners and compare their incomes after housing costs with the poorest 20% of families, the poorest 20% of pensioners are better off than the poorest 20% of the families. So it extends even down to the bottom of the range. Now, let me turn to some observations on his particular points, which I hope we'll be able to investigate further in our discussion. And here I had got a couple of observations. I was a bit surprised that David didn't think anxieties about paying for social care were that significant. I do think that that is a big uncertainty, which might lead people to hold more savings than would otherwise be necessary. I actually thought that some of the Dilnot proposals, Theresa May's attempt to launch them, with some expectation that more affluent older people should contribute to the costs of their care, made a lot of sense. But they needed to know, they needed a minimum floor and a cap. They needed to know that there was an upper limit above which they wouldn't have to contribute, and perhaps a minimum above which they would, below which they wouldn't start. So if people would be confident that there was a stable policy environment in which either it was all paid for by the taxpayer, or, as I would prefer, individuals did have to make some contribution, but it was capped, so they would never face devastating financial consequences relative to their wealth, then I think that would lift a burden of uncertainty that is one of the factors that perhaps David underplays. The other bit of David's analysis, which I would challenge, was his very surprising figure, yes, £647 million, which he estimated as the amount of money that grandparents give to their grandchildren. That is an unusually low estimate. Using a rather different methodology, an Ipsos Mori survey of older people asking how much money they gave to their grandchildren, you get a much larger figure, 10 times that, 8 billion pounds. And transfers that are on the same scale as the value of child benefit. And there's another puzzle which we are researching at Resolution that also suggests there are much more significant transfers inter vivos than David suggests, which is the puzzle of the size of estates on death. We've been expecting the value of estates on death, as shown in probate, to rise. They have been rising, but they've not been rising by as much as forecast. It looks as if older people are getting rid of some of their wealth in ways that aren't currently being picked up before their death. And one mechanism could be large transfers to the younger generation during their lives. So I personally think that is a key factor. And that's the point on which I wanted to conclude. I'm not a generational warrior. I do think that the generations care for each other. I think older people want to help their children and grandchildren. It's not just grandchildren, it's mature children. A lot of these transfers are already happening, I think, on a much greater scale than David allows for. As he rightly said, sometimes there's an element of control in this, as we try to understand why young people aren't as geographically mobile to new jobs as they used to be. One suggestion is that the networks of financial dependency on their parents and grandparents are greater, so they stay closer. But these are fundamentally a good and admirable human instinct to want to help your children and grandchildren. The question is whether we should also be doing more in general for the younger generations, and whether we can also expect older people to make transfers in other ways, and ensuring that they pay for social care when they can afford it, rather than all of the burden falling on the young generation of workers through their taxes, I think is one way in which the older generation, by picking up a burden for themselves, can ease the burden on the younger generation as a whole. But overall, a really interesting analysis, a really useful list of the key factors at work here, and more work to be done on working out exactly how much weight we attach to each one. Thank you very much indeed.
Thank you so much, David. Thank you. And I realise that I've been completely remiss in my job as the host in not actually introducing you fully with your full biog. So please let me put that right away, because let me explain that Lord Willett served as a Member of Parliament for Havant from 1992 to 2015, and as Minister for Universities and Science, and he previously worked at HM Treasury and the Number 10 Policy Unit. He is the Visiting Professor at King's College London, a board member of UK Research and Innovation, a board member of Surrey Satellites and of the Biotech Growth Trust. So I really apologise for not serving up your entire CV before you started to talk, but thank you so much for that analysis. And I think there's something also very, very interesting in what you talked about, the sort of intergenerational care for each other, and that actually maybe there's a role to be played where older people are helping out younger people so they themselves spend more as well. So actually that's another dynamic to bring into the equation, isn't it? That's really interesting. Thank you. So let me now invite Jenny Holt to give her thoughts and views on the report. I will make sure I give your CV first, shall I, Jenny? Okay, so Jenny's worked for Standard Life for 15 years across various roles. She's a qualified actuary who started her career doing more traditional roles in finance before moving on to work on large projects with a wider business focus. Since 2009, she's worked in proposition roles, leading the investment solutions team for 5 years before taking on broader responsibility for the customer and workplace channels, which has ultimately led to her current role as proposition director for the Phoenix Group Life companies. As part of this role, Jenny is responsible for the design, delivery and management of propositions to support customers to and through retirement. So Jenny, the floor is yours.
Thank you, Diane. And I'd also like to start by saying really welcomed this report. I thought it offered some fresh insights into what is clearly a very important topic. I personally found some of the observations around inclusive design and also advertising very thought-provoking. But given my background, I thought I would focus in on the third priority area that was highlighted in the report, which is around helping people to understand how long they might live, and also sort of creating financial products that offer financial security for whole of life. So on that first point around longevity, I mean, David included in his opening remarks the statistics about average life expectancy, and so clearly there are statistics out there which could be used as the basis for rules of thumb. So average life expectancy from age 65 at the moment is currently about 20 years. So maybe 85 as a benchmark is helpful. However, the point that David also made is very important in that these are only averages. So it is important that we can provide the mechanisms to help people understand the potential implications of different outcomes, and particularly of living beyond 85. So thinking about sort of financial security for whole of life, the Pensions Policy Institute published some research towards the end of last year, which was looking at the retirement prospects of Generation X relevant to the generations immediately before and after them. And in that report, they framed or they looked at retirement income through 3 different lenses, which were adequacy, sustainability, and flexibility. And I think those are relevant and useful when thinking about why consumption dips when people reach older ages and in retirement. So if people are spending less or choosing not to spend more, whether that's because they do have concerns about how they're going to fund care costs at older ages, or just because they're uncertain around how long they need their money to last for, then that speaks to concerns around sustainability. And equally, where consumption is dipping as a result of people just not being able to spend more, largely as a result of an inadequacy of saving for retirement, then that speaks to the adequacy point. And I think in relation to adequacy, the report also calls for an investment in preventative measures to improve physical health in later life. But I think there's also a need for an ongoing investment in preventative measures to improve financial health in later life. And we've already seen, some great interventions in that area. So auto-enrollment has been phenomenally successful in increasing the number of people who are saving into a pension. So I think, where we need to go next with that is thinking, well, how can we expand the reach of auto-enrollment to encourage even more people to start saving for later life, whether that's starting younger or starting to think about self-employed. But we also need to be thinking about how we can encourage higher contribution rates, because there's a piece of work that the PLSA has done around retirement living standards, which give people a really useful framework for how much that they might need in order to provide different standards of living in retirement. So there's 3 levels. There's minimum, moderate, and comfortable. But an even more recent piece of research carried out by the Institute and Faculty of Actuaries demonstrates that if you want to achieve anything more than the minimum, then you need to save considerably more than auto-enrollment minimums. So there needs to be ongoing focus there. So turning then to the products that are already available today to help people with the provision of retirement income. So each of those, I guess, has differing characteristics when you think about the attributes of sustainability and flexibility. So annuities, they provide guaranteed sustainability, but the trade-off there is in relation to flexibility. But they are, in my view, certainly a massively important product, because they can provide that peace of mind, and also they don't require the same degree of ongoing review and management as some other product options. I think the do suffer from a bit of a poor reputation at the moment. So perhaps they're in need of a bit of a rebrand, or maybe even thinking about how you use annuities differently to how they have been in the past, for example, by combining them with different products, or perhaps considering them for use slightly later in life. And I think one other sort of key point about annuities is that they will continue to be, I guess, relatively expensive in low interest rate environment, and I think there's an education point needed there. Drawdown, on the other hand, offers maximum flexibility, but in return for that, people are essentially then taking on longevity and both investment risk themselves. So they need to be much more sort of hands-on and involved in ongoing decision making if you go down that route. And then finally, equity release probably sits sort of somewhere in between in terms of flexibility and sustainability. There's been some real improvements in product design and equity release in recent years. It's now a fully regulated market. It's an advised process. So I think there's potential opportunity for growth there, and also it's a product that can help with the adequacy point as well by helping people be able to translate asset wealth into cash. So I think all in all, the products that are already out there in the market do allow people to I guess tailor the amount of sort of flexibility and sustainability that they want to have around their retirement income. However, the challenge is that being able to evaluate all of those options and perhaps review them and change them on an ongoing basis is in some instances inherently complex. So it's really important that we have the right degree of sort of decision-making support framework around those options, whether that is guidance and advice, and that the process of evaluating those options also includes people facing into some more difficult topics like later life vulnerability or future care costs. But that framework also needs to make sure that it supports not just sort of first move to retirement decision making, but continues to support sort of decision and review throughout retirement.
Great, thank you so much, Jenny. That's terrific, thank you. And now finally, our last panelist, last but not least, obviously, Isabel Schmingen is the Deputy Dean and Professor of Marketing at the Birmingham Business School. And her research has largely looked at the implications of consumer behaviour for marketing and social policy. And the focus of her research has included older consumers, alcohol and food. She's received grants from the ESRC, British Academy and ERAB, and she's a trustee of Alcohol for Alcohol Change and a governor of Birmingham University Hospitals Trust. So I'm going to hand over to Isabel for her thoughts on the report and any points she wants to make. Please do keep putting your questions up in the Q&A section. I can see there are some questions, great questions coming in, so thank you for that. Keep that up, and do keep tweeting on using the hashtag #LongevityDividend and at ILC UK. So Isabel, over to you.
Thank you, Diane. I'd like to make some general points about marketing and old age, and then some more specific points around David's presentation. So I'm glad to see we've got our favourite picture up there. To begin with, one of the most important things in marketing, in my view, is not to assume age as a predictor of anything, and particularly not behaviour. Okay, there are sort of some things, you know, babies need cots and teenagers are more likely to go to festivals, although not exclusively, and you know, sort of mobility aids are more likely to be for older people. But these are very kind of specific aspects of age. I'm just going to make a sort of like one analogy to work that was done by Professor Gordon Foxall, who some of you may be aware, very important economist and psychologist, and he wrote about the difference between adapters and innovators. And I'm using this as a kind of sort of a metaphor for how I think marketing looks at older people. So innovators are the people that go out and buy whatever and they're right at the forefront of things. But the interesting thing about adapters, and I think if we put if we kind of imagine older people in this, is that an adapter is somebody who has really got to know the product class. And I think the assumption here is that once they get to know the product class, whether it's the thing that they're interested in, fashion or makeup or food or cars or whatever like that, these are people who are not interested in everything, but what they are is that they develop a greater interest in the things that matter to them. And my argument here is that just as because you age and maybe you don't have to go to work and you don't have to spend sort of your money on certain kinds of things, it doesn't stop you from being a fashion geek or a techno geek. I know lots of petrol head men, usually, I have to say, in their 60s and 70s and 80s. Many of them have turned into Tesla heads, I have to say, but that's part of the sustainability agenda, perhaps. Of course, in many ways, these are people that are a problem for marketers because they are discerning, they are critical. They probably don't shop around in the way that we want people, if we're marketers, in this impulsive way. They ask more questions. But the idea that they don't shop, I think, is a mistake. Older people do buy things. But I think one of the things I want to come back to, which reflects one of the questions that I've noticed come up on the chat, is we've got to be very careful about not looking always at averages. Averages, I think, are a problem here. Marketplaces are much more complex than sort of saying all older people do this or younger people do that. I think, one of the things we can see is that older people can be very innovative in certain ways. I mean, if it comes to something like sustainability, again, I think keeping your house warm and your electricity bill low is often sort of where you'll find older consumers at the vanguard of, the latest technology. So again, don't assume that they're right behind the curve. Secondly, I just want to sort of say something about using age as a segmentation tool. There's a real problem about lumping all people together over the age of 65. And I've lost count of the questionnaires that put you into age categories 20 to 29, 30 to 39, and then it's 65 plus. Why not 60 to 69, 70 to 79, 80 to 89, or whatever? In my view, it's not realistic, and it's frankly insulting to imply that after 65, there's some kind of mass homogeneity, because there just isn't. And if you look at the image that we've got up on our screen, I think that's the kind of thing that, results from this view of age as homogeneous. So that in turn links to how older people are presented, and how older people are presented is something that I have been, going on about, like, I have to say, for 20 years as I have got older, obviously. And it still seems that you've either got to be, Jane Fonda fighting back the lines and the wrinkles, or a comic kind of character of the Doc Cotton, from EastEnders type. And to my mind, it's essential that we revisit the presentation of older people, not just about their appearance, but it's also about how older people feel about themselves, which I think is hugely important. And we've got to stop presenting older people as either feeble or comic, which I think is one of the things that we see a lot of. And it's not just about in marketing, it's also about how the media generally, TV programs, sitcoms, reality shows, all of that are complicit. And I'd suggest it's not just about doing away with the usual trope of the older person, but actually proactively presenting something that is more assertive and powerful in the presentation of older people. And this extends to the products and services that are being offered. And again, I'm going to take an example from my own experience of gyms. At my gym, there are classes for over 50s and over 60s. And I just sort of think, that's so unnecessary. Why don't we just have it in terms of an easy workout, a difficult workout, an in-between workout, whatever. I mean, the marketing people can come up with better terms than me, but it doesn't have to be age-related, because I don't think that many people currently that I know in their 50s, 60s and 70s see themselves like that. Now, going back to the average point, I think one of the most significant divides is between the haves and the have-nots, and this goes to the state pension and so on. Living on a state pension is tough, and many older people just don't have the resources, and not just in bricks and mortar. We need to recognise that what those with economic resources can do will be very different than those without, and we have to. And that's why, again, I think averaging is dangerous. Inevitably, one of the biggest problems areas here is technology, and again, access to technology. Now, this may be a little bit controversial, but one of the things I think we've got to bear in mind is that as generations pass on, the next generation of older people are going to be familiar with technology, and they are not going to have some of the same resistance that that people have now. Having said that, I see a lot of older people. I see older people on TikTok. I mean, I'm hoping some people here know about TikTok. In fact, there's some very, very interesting older people on TikTok. So I think, again, we've got to see the broader picture. And just a couple of points in relation to the things that David said about, in particular, I think about gift giving to generations. I think that this is a really important thing. I take on board both what Lord Willett said about that and what, as David said, and I guess it's somewhere in between, but it does seem to me that there is a big opportunity for that. As I have recently become a grandparent, you know, we've already, without strings, invested or given, you know, some money. But I think a problem very often is the tax implications that people are concerned about, and keeping track on that. And just finally, I think going in a post-COVID world, one of the things that we are going to have to be very concerned about is older people and employment. And we are going to see a lot of jobs lost. We're already seeing that. And I think that we are going to have to be concerned about our younger people not getting the opportunities. But when we do that, I think we've got to forget that there are still many older people in the workforce who, whether they're in the paid workforce or whether they're doing voluntary work, that have a great deal to offer. And I really do hope that one of the things that doesn't happen is a kind of taking the eye off the ball in terms of what older people can do. Thank you.
Fantastic. Thank you so much, Isabel. Well, there's clearly a lot that we can dig into there from all our panelists. I would perhaps ask both David Sinclair and David Willetts to turn their videos back on so we can see you, because now we're going to start working our way through some of the questions that have come in, and do keep them coming in, please. You know, don't think that because we're starting to work our way through them you can't add some more, and you know, and include your comments and thoughts in the chat. So keep your questions to the Q&A tab below and your comments and thoughts on the chat, and we'll try and keep an eye on all of it. I'm going to start working my way through the questions that have come up so far. So the first two on the list are from Violet Rook. I'm not sure whether they're questions or actually just more statements, Violet. So maybe I can go to the first question, the first very clear question, which is from Darren Sage, who's asking what David thinks financial services can do better to help people feel more confident in releasing their savings instead of worrying about long-term care costs or savings for a rainy day. And where does he see the product gap? Now, I'm assuming that's a question to David Sinclair, although it'd be interesting also to hear what your views are about that, Jenny. So maybe we'll start with you, David Sinclair.
Great, thanks. And I think, thank you to all the other panelists. I think really interesting. I think what can financial services? I think firstly, support saving. You know, we have had a period where for the first time, pretty much ever, older people are not more likely than other ages to be living in poverty. But with the end of DB, that's likely to change. So the industry can firstly support us throughout our entire lives to accumulate wealth. So we've got to make sure we make the most of auto-enrollment and build upon that strength, increase minimums. I think second, I think the industry's got to support all of us to get the right sort of advice we need. And I think, again, extraordinarily important that we are, you know, there isn't you know, there are lots of different answers to this question, but we've got to make sure that people have the right access and to advice and guidance. And then thirdly, I think the issue of you know, actually we have to have the right sort of products to support decumulation, and clearly pension freedoms resulted in a big sort of jump from annuities. But actually, and you know, ILC, we were one of the fans of annuities, and it allowed you to manage your wealth across those last few years of your lives. You know, we need some alternatives, or we need to find better ways of selling annuities. We need to convince people that there is a value of different, interesting, safe products, and including, Jenny mentioned this, things like equity release, supporting other sorts of mortgages, supporting downsizing, moving to rented accommodation might be an option for some. So I think that, you know, and perhaps the final thing on financial services is that, of course, historically, we've always said to people, look, you know, you should be buying an inflation-linked increasing, you know, value annuity, because that's going to give you more money and guarantee you income for longer. Of course, actually, if the reality is that our spending does fall with age, perhaps we don't need some of that inflation-linked. You know, perhaps we actually need the greater amount of income in our, you know, late 60s and early 70s, not in our 80s and 90s. So a few thoughts there.
Jenny, what are your feelings about both that and the point that was made by Darren in his question?
So I think maybe to build on some of the points I made in my remark, I think probably the biggest challenge at the moment isn't necessarily that we have product gaps per se. I think we potentially have sort of decision support gap, where, you know, there's a lot of kind of coverage about the advice gap, more generally, where there are, you know, a large number of people who could benefit from financial advice, but for whatever reason at the moment aren't accessing it, predominantly due to cost. So how can we improve the provision of decision support, both in the run up to retirement, but then also post retirement as well? And we've seen we're starting to see sort of innovation around sort of digital advice propositions, which potentially have the option of being more scalable and more affordable. But I think there's probably also more that we can do in the guidance space as well to help people navigate these decisions. I think from a product perspective, there probably is more that we can think about in terms of helping people to understand how they can combine the different products that are available. I mentioned earlier thinking about using annuities differently. So historically they were purchased right at the point of retirement, but can they be used to provide, say, a basic income underpin, or potentially to secure a guaranteed income later on in life, at the point where somebody maybe feels that drawdown is becoming kind of too complex, and they just want a kind of a simpler option. We've not seen much to date in terms of innovation around different types of guaranteed products or investment options. I think the low interest rate environment does make that challenging, but I think it would also be good to see more in that space as well.
Thank you very much. Yes, certainly guidance for people through the complexities of, you know, the financial offerings that are there is so important, because it's very easy to lose sight of the fact that for a lot of people, they're not literate in even the language that's used in the way these offerings are presented, and that can really put them off trying to understand, and even if they do actually understanding. So I think that's a really key factor, isn't it? I'm going to move on to a question from Steve Smallwood, which is sorry, hang on a second. No, Neil Lovett, I beg your pardon, which he talks about the fact that as the proportion of older people in society increases, aren't there going to be a larger proportion of poorer pensioners? And I wonder if David Willits, you might want to address this one.
Yeah, and this of course ties in with some of the other thread that's been going on, people who are unhappy that I've quoted averages.
Yes, averages. I was going to get to that one too.
Isabel commented on this, that sort of the averages are misleading. Well, I think the averages are not misleading. If you look at the more granular data, if you look at it broken down by 5-year age groups, if you look at it men, women, the overall picture is absolutely clear. By and large, the older generation are more affluent, higher incomes, more wealth than ever before in their history, and have also gained relative to younger generations. And when people say the average is misleading, I presume they're implying this is a very small number of very rich old people, and there are lots of very poor pensioners. But there's research that's checked this out. That is not the case. There are fewer poor pensioners as well. Indeed, I actually thought that what David Sinclair said a few minutes ago was a very fair summary of the evidence. For the first time in recorded economic history, an old person is no more likely to be poor than someone of working age. Now, you can regard that as a massive social advance. Certainly going back to the debates in social policy I was involved in 30 or 40 years ago, people have said this was fantastic progress because poverty was concentrated amongst old people. But the evidence is overwhelming. It is not some misleading average behind which you find a completely different picture. The evidence is overwhelming. Older people now are no longer more likely to be poor, and they are more likely to be well off and have significant wealth. So the average is actually has behind it a large amount of very granular data, and it all confirms the same picture. Now, what you do about this, as I say, in many ways, it's good news, but I personally think one of the biggest single problems we've got in public policy, which is exactly the same as the commercial marketing image which people were objecting to, is we've still got leftover assumptions in public policy that if you're old, you must be poor, and if you're poor, you must be old. Those are just not borne out by the evidence. So now, as to what will happen in the future, there is indeed a risk that future generations, currently rather younger, will not, when they are old, have the same living standards as today's older generation, because today's older generation have high living standards as a result of some very unusual circumstances. Very high rates of property ownership, which is why, incidentally, all these claims that the averages are misleading are incorrect. Very widespread property ownership, 3/4 of pensioners property owners, most of them with the mortgage paid off, plus also widespread access to defined benefit pension schemes, which are now closed to younger generations. So yes, there is a risk that the younger generation will not have the same kind of living standards, which is why I strongly support, I think, what Jenny was saying a few minutes ago. We should absolutely look at ways in which we can make auto-enrolled pensions more generous, help people build up bigger pots during their working lives, because there is an issue as to whether this extraordinary social change with the affluence of the older generation will not last.
I wonder if I might bring in Isabel on this one. Do you think that that is also, that feeds into the reluctance of marketing, advertising and their clients? So let's go back to the point you made that actually, you know, they're not being commissioned necessarily to talk to these audiences. Is that kind of stereotypical and, you know, what David Willetts is saying, wrong assumption that old people are poor? So they simply don't have the money to spend, so why bother advertising or marketing to them?
Well, it's difficult. It's difficult to be specific on this because, first of all, I don't have the data that Lord Willetts has got in front of him. So I'd still like to kind of sort of make an assessment of that there will be some subtleties within that data. I find it difficult, like I've been saying up to now, to sort of say out there's a whole load of rich old people, right? So I just want to get that out there. I think that I think that there are all kinds of all kinds of almost structural problems here, in as much as that the way people kind of present things are about you want to look younger, you want to be younger. That is that is, if you like, sort of the holy grail, and that's got a long kind of cultural context in Western society, possibly not so much in other societies, but and I think as well, you know, one wants to sort of, you can look at this globally. And one of the slides that David showed earlier was of, you know, Asian countries, and older people in Asian countries often don't have the benefit of having a pension, and that's why they're working at the racecourse or I mean, if you have a look in, you know, the airports and so on, they're all older people, you know, sweeping up. So I know I'm going kind of sort of slightly off piece there, but I think I would just like to sort of take up 2 points about finance, and one I think that Jenny kind of intimated is that still finance is incredibly difficult to get your head around if you're just an ordinary person. And you know, the amount of, like, when you have this kind of this overall dilemma of annuities or, you know, a cash sum and whatever, I think that's really difficult for people to get their head around, particularly when they're looking into the future. And we must remember as well that long-term, you know, long-term finance options like shares are going to be less, you know, less required, if you like, as you get older, because you don't want a short-term loss. So I mean, even in sort of things like that, I think are complicated. But just I know I'm kind of mixing up a lot of different things, but just to go back to your point, Diane, about it. To me, the structural issue is also about the people that do the communicating, the media. So it's not just advertising, the media, and we know that the media's got like its problems and so on. The people that work in the advertising agencies, not only are they mostly under 40, and they are, you know, many advertising directors retire well before they're 50, but they're also very gendered. You know, it's often, there are more women in advertising than there were, but there's still a lot of men. And again, not suggesting that all men have got that perspective, but I think it is what we need more is people who understand what it is like to age, and what are the different factors going on. And you know, we see this in all kinds of other areas. Once you get people on board, whether it be, you know, sex or race or age, there's a better understanding of what's going on.
Okay, thank you very much. Can I pick up on one of the points you made about sort of diversity across different societies and countries, because that feeds into a question here from Stephen Boxall. He asks, is there any research on how elderly or older people save and spend in different countries and societies, and if this differs between them? If a society has secure social low rent housing, do older people spend or save to a different pattern than the UK? I'm wondering who might be able to pick that up. Lord Willits, would you be able to make a comment on that one?
I mean, there are some differences. Oddly enough, it partly goes on things like co-residence. So there are societies which have an even higher focus on paying, say, pension benefits than we do, and even lower rates of benefits for families. And they are often associated with more intergenerational living. So there are intra-family transfers. So for example, a lot of old people in Japan live with their middle-aged children and transfer some of their income within the household to them. So you can find societies where there are bigger intergenerational transfers within the family, often associated with greater co-residence, first point. And second point, then I'll stop. There was a very interesting experiment, an unusual experiment, when Germany unified. And one of the things which the new unified Germany did, one of the first benefits to go up was benefits for pensioners in East Germany. And there is significant evidence that one of the first things they did with that is pass that extra money on to their children. So there was nothing like the increase in consumption by old people you would have expected. Instead, they passed it on to their kids. And that, of course, is one of the excellent 10 factors in David Sinclair's list.
David, you've done a lot of presenting on all aspects of this around the world. Have you found in your travels and research that there have been differences in the way?
I think in terms of consumption and spending, if you look at the economic literature, places like Japan, UK, US, Korea, France, it's a very similar pattern in terms of spending, which does sort of lead us towards perhaps there are some of the issues around, it might be some of the issues around ageism, precautionary savings, that we've got enough stuff might actually be a common thing that happens in some of these countries when we live longer. So I think that you certainly see that in wealthy countries consistently. So in terms of the other side of it, the saving, the accumulation, I think there are things that we can learn. Across our lives, we have different needs for income and expenditure. We might need more money when we've got a young child, and we might need more money when we want to buy a house, and we might need less money at a certain point of life, and the extent to which we need more or less money varies according to social security systems. So in the UK, we have an NHS. That means that actually, we have capped prescription charges. You have, health costs for the individual do not increase significantly with old age, whereas in some places, of course, they do. We have less reliance on private insurance, for example, as well. But actually, across our lives, we probably have enough wealth, most of us, to live our lives, pretty comfortably, or at least very well. But how can, coming back to the previous question, the financial service industry deliver us products across our whole lives that help better match our income and expenditure needs? And of course, in places like Singapore, you have the ability to draw down your savings pot against a house, for example. So your pension savings pot, you can use some of it for a house. Now, should we or should we not go that far? There's a question I saw from Alistair from Aviva around sort of, is 55 too young or too old to allow people to start drawing down their pensions? I think 55 is a ridiculous age to start to draw down. For most of us, it's far, far too young. But on the other hand, I do think that actually we maybe need more and better products that allow people to draw down some money at the point we need it for housing, for the money we need for our lives. And I think it can't be beyond the wit of the financial service industry to do this. The reason we see younger people putting money into cash-only ISAs, saving is big, in low-risk accounts as well as older people, is that actually they're conscious they need the money for the house. Can we not find ways of creating products that better support income and spending throughout our whole lives?
Okay, so let me, so I'm going to pick up on a question kind of out of the running order of the way they've come in, because I think that this raises an important point that we've just touched on earlier, and I'd really like you to hear what you have to say about this, Jenny, about the complexity of financial products. And Philip May has said, several of the panelists have mentioned the complexity of financial products. What do the panel think can be done to increase financial education across the generations, and how can the financial services industry help? So I think there's lots of layers there, because actually I'm sure each of you have got some very interesting perspectives from your own expertise. But let's start with you, Jenny.
So I think one of the key areas where we could look to sort of deliver more financial education is through the workplace. So as part of the Phoenix Group, the Stand Life Workplace book has a large number of workplace pension schemes, and we already do work with a number of employers to run events within the workplace or to provide educational material. And I think one of the advantages to that is around who do people trust? So who the message is coming from is very important in how people will engage with it. And I think sadly, if messages around saving more into your pension coming sort of directly from a provider might be viewed as self-serving rather than for the purposes of the individual. But when they're delivered in your workplace through your employer, and there's essentially that employer endorsement, then we tend to see engagement increase. So I think the workplace has a very important role to play in helping to deliver that financial education. Ideally it should start earlier. It should start in schools. I know there's been various initiatives looking at how we can get financial education into the curriculum. I think it would be fantastic if we could see that. But a recent piece of work I was doing with a Scottish body who were looking at this had done a kind of a relatively informal piece of research with schools. into what are the potential barriers for delivering financial education. And one of those is actually the confidence of teachers in delivering that topic, because like many other people, there's a sort of a nervousness, a lack of understanding, and a perception that it's all very complicated. So there's some challenges that we need to consider and overcome there. But I think that the main point is, I think it's unlikely to be only one thing. I think there needs to be a combination and a kind of collective concerted effort which combines government, financial services providers and employers to help deliver that education.
Do you think, Isabel, there's also oh, sorry, Dave, did you want to come in?
Yeah, I was going to come in. I just, sorry, Dan. I think really interesting. I think this is a really, really interesting question where I think that I'm probably an outlier, as I often am in my views. Firstly, we did some work with the Money Advice Service a few years ago, and we absolutely have no idea what works in terms of delivering financial education to older people in particular. There's very little evidence that many interventions actually work. In fact, one of them that's been tested that actually does work, which is quite interesting given the earlier conversation, is if you show someone an image of their future self, it impacts upon their willingness to engage. So if you show an image of someone looking older, then actually it engages people in learning about some of these things, which is interesting. I think, we went for a period of having lots of people saying we need some leaflets, we need information, we need advice. I had one provider tell me that, and this was at the point where, I don't know if you remember, the Daily Mail and the tabloids used to give away free CDs, DVDs of films like every Sunday for years. I've got hundreds of them still. And I remember a provider coming, we should give someone a DVD about how to manage the money. I think, like, seriously, you've got to be so bored to want to watch a DVD about how to manage money when you could be watching The Princess Bride or something. Seriously, it's not what people want to do. People don't care about this. Actually, what you have to do, and I think this is the challenge for the financial service industry, is we need simpler products that people understand. And we probably need less choice, not more. We need to be told, here is X product, this is good, you should buy it. Actually the whole advice and guidance sort of world has got so complicated. We can't say to someone, you've got this amount of money, you should think about getting an annuity. It's just ridiculous. We need simpler, let's not blame the consumer. Quite frankly, why the hell should we, I don't need to know how the back of my engine works. I should be guaranteed, if I buy a product, that it delivers me what I want through my life. And I think we're far away from that yet. And I think that's the real challenge for the industry.
Isabel, do you think that there's a part to be played, in terms of, if you want the kind of marketing advertising industry and their, collective knowledge and understanding about how to communicate with people, that, we could do something around educating them to help educate older people?
Okay, so first of all, I completely agree with David. I mean, this, while I agree with Jenny, we need to increase financial literacy, but it is literacy. When we talk about financial capability comes from the product. We from the people producing the products. That's because then we can put the two things together. Now, yes, I mean, the fact is that the way financial products are difficult. So we need to look at. I would like people to look at products that are simpler to understand. I think most of the sites that I go on, I think I'm a pretty intelligent person. I have real difficulty even navigating them. Let alone knowing, like as David's saying, to compare one thing or the other. But the point that you make, Diane, about marketing and communicating, I mean, one of the things is that there is I don't know whether, sort of advertising directors don't want to work on the financial services accounts because it's not sexy or something, but there really doesn't seem to be the effort put into communicating the products in a way that people can respond to. Now, I agree with David that essentially these are products that people are not going to be, hugely thrilled about, but that should be a wonderful challenge to make to make younger and older people understand them better.
Where do you see a pathway through all this kind of confusion and complexity, David Willetts?
Well, first of all, I very much agree with what David Sinclair said. There is a limit to how much we can expect people to invest their time and effort in understanding these products. In terms of liberalizing the regime to make it easier for people to save, I personally think that the tax rules for company pensions are quite inflexible. I wanted to make this point earlier, in that they basically require you to take your full income from the beginning, and it should be possible for people to start off sort of with a relatively lower occupational pension, but with the opportunity of increasing it by more than inflation of 5% in the future. I also think that for people who are auto-enrolled, the evidence is very large numbers of them then want the simplest possible available option. So I think the obligation is on us to keep it simple, rather than saying the obligation is on the average punter to get their heads around something very complicated.
Well, that feeds into a question here from Tony. If older people are so well off, why were auto-enrollment workplace pension schemes introduced? It wasn't just about the public sector having difficulties funding state pensions via current taxation. At 8% contribution rates, most people's pots upon retirement would be inadequate. The current trajectory is towards increasing pensioner poverty. So for the majority, more difficulties in spending. And he wonders whether you agree with that. David Willits?
Well, I mean, let me now act as the spokesman for Adair Turner, who's a friend of mine. And I was, at the time of his report, I was the Shadow Secretary of State for Work and Pensions and talked to him a lot about it. You have to distinguish between different cohorts. The old cohorts at the moment are disproportionately likely to be owner-occupiers and likely to have some form of company occupational pension. If you look at people who are younger at the moment, those younger cohorts, they're finding it hard to get started on the housing ladder. And they are also, their pension savings are much less. And Adair would say, as company pension schemes of the old sort, defined benefit company schemes were closing down, and as part of a wider policy consensus, I was on behalf of the Conservatives, people, the Labour ministers were part of it, that we needed auto-enrolment to help the next generation build up savings. Now, I think auto-enrolment has been a great success in terms of participation for the younger generation, but the questioner quite rightly points out that 8% is not enough. And I think a really interesting debate that's now opening up is, having got to that level, what more might we do? And you could imagine options like higher exchequer contributions for the under 40s or whatever. You could imagine expecting employers to make rather bigger contributions. You could imagine making it easier for people to borrow or even take out some of the money in that pot. But yeah, we've got to a very good base of widespread participation in auto-enrolled pensions. Now we've got to make it a bigger, more flexible, more attractive pensions pot so people put more in.
Jenny, would you like to come in on this one?
Yeah, so I think, you know, I completely agree that we do now need to turn our focus into increasing contribution rates. I think the challenge is around, you know, sort of what's the best way to go about doing that. I think particularly in this post-COVID environment as well, when both individuals and businesses are going to be facing, you know, challenging economic circumstances. So there are things that have been, I think, proven to be helpful and more successful at encouraging individuals to increase their contributions. So things like auto escalation, or it's often referred to as sort of Save More Tomorrow, which bring in some of the sort of the behavioural economics aspects to encouraging and nudging behaviours. Recognising the fact that if you say to somebody today, I'd like you to pay £50 more a month into your pension, then that represents almost an immediate loss into the money they have available at the end of the month. But if you say, well, would you like to give a portion of a future pay increase, then that's actually an easier decision to make because there's no immediate loss, and you're not actually at the point where your pension increase goes up experiencing a reduction in your take home. So I think we need to think about lots of, be as creative and explore as many options as possible for how you actually kind of make that happen. So I think that some degree of compulsion will probably be required at some point, but how do you do that in a way which doesn't dramatically increase opt-outs, for example, because that would be a bad outcome, because we want to have as many people continuing to save in as possible. So I think there's a lot more work for us to do, and again I think that's a combination of industry and government and employers to work out what's likely to be the most successful way to achieving that goal.
David Sinclair, was there anything else you wanted to add?
Yeah, I think the group we really have to worry about, and this should be a real worry to government, is that and I would say that I have self-interest here being one of them, is Generation X. Fundamentally, you've got a group of the population who are much less likely than current or recent retirees to have a final salary pension scheme. And at the same time, they're only likely to have benefited for sort of 10, 15 years of auto-enrollment, as opposed to a younger generation who, in theory, might benefit from 40 years of auto-enrollment. So you've got a group of the population who, particularly women, particularly with those self-employed, who are coming through in the next sort of decade or so, who will be this first group. And some of the questions have flagged this, where they haven't got a final salary pension, and where, so I think that's, as well as, and I think Lord Willetts is right, actually we need to make sure we are getting people to save young and save well and take risks as well, actually, but actually perhaps we also need some specific interventions around Gen X, so people who are currently sort of mid 40s to late 50s, where actually they really, they are going to be faced with some really tough decisions, and their pension wealth is they maybe have very significant challenges.
I'm mindful that I'm trying to work through as many of the questions that are coming in as possible, so I'm going to just nudge this on ever so slightly, but it's still related to savings. And there's a question from Neil Lovell, who says, isn't part of the problem with encouraging saving that disposable income is just unavailable? The ability to cope with financial shocks such as COVID for many of working age is low. Work insecurity, the rise of the gig economy, etc., is surely going to impact saving. Wasn't there a stat recently in the US that a large number of the population had less than $500 to fall back on? Is that an issue in the UK too? Jenny, can you respond to that?
I think that is an issue in the UK too, and we see that from research that we've done, particularly with younger savers who, they have other pressures on their finances, which are far more front of mind than pension savings. So whether that's making ends meet and paying your bills month to month, or family expenses, or saving for a first house, or paying down debt, whatever it is, there's lots of competing demands on people's money, and that's a hard challenge to solve. But I think what we need to try and do is find a way of recognizing that there are these sort of tensions and challenges on people's finances, but still encouraging them to take both the long-term and the short-term view, and what kind of tools or support can we give people to help with budget planning and with decision making. Because we did a piece of work recently where we were looking at an initiative which was around giving people an app to help them with saving for their first home. And actually what came out of that was that a lot of the people who participated in the research we're talking about sort of budget planning and help with that. So I think there's a need there, and that could be used then to, I guess, help people make those decisions between the short term and the long term, and maybe better understand what's actually possible.
David Willits, what's your thought about how we can best encourage people to build up a sustainable pot of money in terms of having savings to fall back on, but also then to encourage them to feel confident about spending money with that as their financial cushion?
Yeah, I mean, I very much agree with the analysis. And when we did our intergenerational commission at the Resolution Foundation, that's why one of our proposals was that when people got to the age of 30, they should be given a capital grant by government of approximately £10,000. That's would cost about £7 billion a year, so less than 1% of public expenditure. And we even identified some taxes you could increase to fund it. And then you'd go on the TV and talk to some TV presenter who said £10,000, you know, what's the point of £10,000? To which the answer is, for 3/4 of young people, that more than doubles their entire personal wealth. And you could use it either, and you then set some conditions of what they could do with it. One obvious use of it would be they could put it early on straight into their auto-enroll pension to get it compounding for them. They could use it to pay for education and training. They could use it as a deposit to help buy a flat or house. So yes, I do think the younger generation lack that cushion. And when we look at options for promoting more auto-enrollments, I agree that with Jenny that Save More Tomorrow is an ingenious device, but we have to be careful of expecting too much from today's young people who are struggling to make ends meet. And again, I'm going to talk on another figure, an overall figure, but it applies absolutely at the individual scale, which is for the last few years, the cash value of family benefits has been frozen. So they've fallen in real terms, whilst at the same time, pension benefits have risen by the triple lock. The gap that's opened up between the benefits we pay to an individual pensioner and the benefits we pay to an individual younger person or person with a family has got wider and wider. So we need public policy that focuses more on helping younger people make ends meet.
David Sinclair, anything
I was just going to say, on the gig economy stuff, I think there's a couple of points. One is that it's about 1 in 10 over 50s who are currently self-employed, who are working, whereas, sorry, it's 1 in 10 under 50s who are self-employed. It's about 1 in 5 over 50s, surprisingly. So the sort of perception of the gig economy is just young people is often wrong. And in fact, older people who are self-employed actually, but the over 55s who are full-time self-employed tend to earn less on averages again, than younger people who are self-employed. So there are some significant problems across the whole life course in terms of self-employment. Although I do also think that, you know, and I'm sort of, you know, pulling together self-employment and gig economy, which perhaps I shouldn't, but that actually the gig economy and work is potentially much more of a value to an older person than it is to a younger person. If you're a younger person and you are an Uber driver and you have no job security and no guaranteed income, your ability to save is really, really limited. You know, you're potentially forced into work longer than you'd like. If you're older and you just want to work a few hours a week, actually, you know, taking on a gig economy job or 2 or 3 gig economy jobs where you're doing what you want in a flexible sort of way, and it's almost a top up, it is entirely sort of, you know, is potentially, you know, much more positive, which does sort of bring me on to we shouldn't forget about in the debate around financial service products, the really, really important role of work. Work not only drives consumption and spending, but actually if you work just a little bit longer, not only do you benefit from those couple of years of extra income, you've benefited from not drawing down your pension from a couple of years, and actually, you know, I think we sometimes forget that actually work probably has to play a greater role in terms of supporting income and indeed expenditure in old age.
Yeah, could I just comment on that, Diane? Just come back, because I mean, David, I agree with a lot of what David has just said, and I should have let me provide the evidence as I see it, which is in terms of the economic impact of the coronavirus crisis and the groups who are worst affected. it does look like it's a kind of U-shaped curve. It looks as if the people who are concentrated in the gig economy jobs and who are concentrated in the sectors like retail and hospitality, which have been most affected, are heavily under 30, but also there's a significant group over 60. And it looks as if the 30 to 50-year-olds are the one who have been least hit. So it is absolutely the case, and I very much agree with David, there is a group of those over 60s who are themselves very vulnerable at the moment. As we try to understand their characteristics, one of the key characteristics, incidentally, is they're much more likely to have a DC pension than a DB pension. If you've got a DC pension, the incentives to carry on working, maybe because it's not worth much, maybe because you can put more in and you can see the direct benefit more clearly. Looks like that's very strong. The only difference is, of course, for the younger people, there is a long-term scarring effect. For the extra anxiety with younger people is that if they have a spell of unemployment or they've just left college or university and can't find a job, the evidence is that that has an effect on their lifetime's earnings. And the scarring problem is less acute if you're in your 60s, but I completely agree with David. There is that group and we need to pay attention to them.
I'm very aware that we haven't really included you much yet, Isabel, so I'm going to do a little bit of a pivot at this point because there are a couple of questions that have come in specifically for you in addressing marketing. Julian has commented that given the contents of this report and the reminder of the enormous opportunity to be realised by understanding and targeting older consumers, why does the panel think there isn't the demand to do better from clients and agencies? And then earlier there was an anonymous question directly for Isabel, which ties into this, from somebody who previously worked for a large over 50s organisation where they actively tried to use younger looking over 50s to attract a better socio-demographic class of customer. And do you, Isabel, see a difference in how customers should market to different socio groups who are over 50? So let's start with that, and then we can perhaps go to a broader panel, the broader panel's thoughts on older people. So I'm starting with you, Isabel.
Yeah, so there was this sort of understanding that advertising agencies spoke a lot about, and their clients also in the last, like when we did some research on this, which was about shielding younger people from having to see older people. Okay, so this was kind of like one of the things that what they were concerned about was that if they presented older people in their marketing, younger people would actually be put off the products. And as still, you know, the mantra in marketing is consumers in training, consumers in training. If we can get them as their kids or teenagers, then they'll stay with us. So the kind of overall focus has always been on youth. And we can see this in the ways things are presented, because youth is more fun, youth is sexy. It's in some sense, it's going back to a kind of Maslow's hierarchy that David showed earlier, just a little bit higher up to the kind of sex and relationship things, which is what you can build a story around in advertising much more easily. Now the thing is, there's lots of evidence to show cognitive age, the difference between chronological age and cognitive age. And this goes back to this idea of we want, or we see ourselves as younger. And I think most of us do. You know, I don't know whether you've had this kind of experience of you see somebody, you think they're quite old, and then they tell you that they're 5 years younger than you are. That happens to me quite a lot. It's about our perceptions of ourselves. And there is a lot of evidence to show that it is generally, if you are targeting by age, and you know, I've kind of sort of said I'm not that keen on it, but it is better to show people of a slightly early age. I mean, it tends to be actually about 9 to 10 years as, using an average here. But when we talk about different socioeconomic groups, this is a very, very difficult thing, because this is where I really, again, like don't feel comfortable with averages. And I'll give you an example. It's not really to do with age, it's to do with size. And again, we know, for example, that within different socioeconomic and geographic groups, this is very specific stuff, people perceive size differently. So, you know, somebody that some people might say was overweight, they would say is normal size. That's basically it. So I think you have to be, if you're going to go that sort of socioeconomic route, you have got to really fine tune your research. And this is one of the things that I think that there isn't enough of in the marketplace at the moment, is really good market research to see how people respond to things and use that in a, you know, in a more constructive way.
David Sinclair, do you have anything to add to this about why you think there perhaps isn't the demand to do better from client and agencies in talking to this audience, in marketing to them? And, you know, that includes obviously what we've touched on, the marketing of financial products.
Yeah, I think a few sort of thoughts. And I think one thing worth reflecting on is, I think, you know, there have undoubtedly been some improvements over the decades. I think, you know, and I'm always trying to wind the financial services. I think the financial service industry is still pretty terrible in the use of imagery, and I think there are big challenges to overcome. I think where you started to see some change is, I think if you were to look at, you know, yeah, I'll give you an example outside financial services. But if you look at the charity sector, you know, 10, 15 years ago, breast cancer charities almost exclusively used imagery of younger people, whereas actually the vast majority of beneficiaries and people who needed their support were older people. And there's all sorts of reasons for that, but actually that's changed. You know, actually there has been a recognition, and there is now in the problem in old age. We have a major problem in old age with stock imagery, which we talked about. So I think that's one point. I think in terms of the one reason that it doesn't happen is because they're not asked. So I was talking to someone from an agency a while back and I said, well, why don't you do more around this? And they would say, you know, the big 20, 30, 50 brands never ask them to pitch for older people. So they would say, actually, there was a lady I met who was a lady who'd worked in advertising for 20 or 30 years. And she said, you know, we get asked 5 or 6 times a week to pitch for 18 to 24-year-olds or even 18 to 20-year-olds, that it's about once a year we get older people. So I think the reality is that some of the companies out there who are paying these agencies don't have an interest. I think part of the problem then comes, and it's comes back to the 10 points, is that, and the point that was just made about we don't know enough about particularly older people's responsiveness to advertising, that it's one of those things where people start delving and it's just far too complicated. You know, where do we advertise? How do we advertise? What group of the older population are we going for? Oh, that's a problem because our market research agency says we're going to have to pay 4 times the amount to get a sample of people aged 70 to 75. You know, there are all sorts of institutional barriers that then the companies go back to the board and say, you know what, it's a bit hard. It's easier just to sell it to 18-year-olds and let's hope they stick. So I think there's a bit of that. And then I think that there is this sort of, you know, linked into that, a real lack of leadership. Again, this is one of those stories that may or may not be true anymore, but about 10 or 12 years ago, Microsoft did a really sort of quite significant investment in product, services, marketing around older consumers. They created a PC that what are called the senior PC. It didn't sell, and they did all sorts of interesting things. Now, what motivated that apparently was Bill Gates read an article in the Senior Manager magazine about demography in Microsoft, and he immediately pulled together a team of 100 people and said, we've got to sort this out. Now, I don't actually think they succeeded, but I do think that there isn't that leadership, particularly in the consumer sector. I think financial service industry get it. I think, you know, IT, telecoms, mobile, retail are, you know, so inherently worried about being portrayed as being an older people's brand that they don't want to touch it.
I'm very aware of the time and the fact that there are still quite a lot of other questions that have come in, but I think we might have to, I'd quite like to pursue one more just thematic strand, and then I think we might have to apologise to all the people whose questions we haven't answered, and maybe there's an opportunity for the panel to answer them on the actual chat itself. But there are a couple about passing on savings and money to the next generations, and there are questions from Steve Smallwood and Tim Lagers. I'm sorry if I pronounced that wrong. So Steve has said, how can we use the desire to leave a better world for children and grandchildren to guide older expenditure. And Tim makes the point, has there been much research into the desire to save money to pass on to family members? And he also then includes that, he broadens that out into friends and causes. While oversaving might be an issue if you're talking about spending habits, it might be a desirable habit if you are wanting to save and pass things on to others in the future once you die. So perhaps we could ask each one of you to just come back with your thoughts about that. If we can start with you, Jenny.
So in terms of research, I think what we found through research studies that we've done around what people want to use their money for in retirement, there's quite there's a wide variation, and being able to pass money on to your family though is definitely one of the strong themes that comes out. So I think that is clearly quite an important factor, driving some people's decision not to spend in later life. So then it really comes down to, well, how can you help people pass that money on in the most tax efficient manner possible. The other sort of theme of that strand of questioning was on sort of how you can use your money to kind of do good. So sort of linking to that theme around sort of sustainability and that I think is becoming increasingly important and a real area of focus across all sort of generations. And there was an initiative launched just yesterday, encouraging people to sign up and back a campaign about trying to encourage investments and pension savings in particular to do more good through kind of how that money is used. So I think that's probably as relevant for older savers or those who are leaving their money invested with the intention of passing it on as it is for younger savers.
David Willits, the impetus to do good, whether it is to pass your money on to the next generation or to give it to good causes, in its own way it is a way of expending, isn't it? Because it's enabling either those good causes to do their work or to enable the next generation to have the money available to spend on the things they need to, so to consume themselves.
Yes, I agree, Diane. Yeah, and it's right that we should want to encourage it. And of course, as we know, as people live so long, if it's to be inheritance after death, then the kids themselves are going to be pretty old, probably in their 60s, though the grandchildren or the great-grandchildren might benefit. If you were to think about what you might do on that, first of all, there is the tax background, and I'm not necessarily advocating it, but if you're setting me the challenge of how to change the tax system to promote it, of course, as we know, that the basic tax rules are that inter vivos gifts you give to your children are probably going to be okay if you then live for another 7 years. And there are also some monitoring of transfers, I think, of more than £3,000 a year. You could imagine making the inter vivos rules a bit more relaxed and increasing the rate of inheritance tax to try to get them shoveling the money out the door a bit sooner. That would be, if I was still sitting in the Treasury looking at tax instruments, that's be the kind of thing one would look at. I think, though, the other point about helping future generations is, and something that I say to all the people on all this, of course, there's this admirable desire to help your own children and grandchildren, but you must also have a view about the kind of world you want them to live in. Do you want them to be in a world where the main drivers of whether you are affluent and prosperous, or that your parents were affluent and prosperous? So something that also helps the future generation as a whole, something that helps a local school, a local charity that helps younger people, even being willing to do basic things like accept that with your wealth, you should be contributing to the cost of your own social care so that the younger generation don't have to pay for it. All that sort of thing is how you help the younger generation as a whole, and as a result, provide a better environment, a more open and mobile society in which your own children and grandchildren live. And that's the other thing we should encourage.
Well, David Sinclair, I'm very aware that we are fast running out of time here, and I know that you probably want to come back on some of those points. And of course, that last one from David Willits makes an excellent point for the whole lifespan, which of course is one of the key factors, you know, of the ILC's focus. So I'll leave it to you now to come back and just perhaps also round up on on what we've heard today from everyone.
Thanks. I think I should say, you know, undoubtedly older people do give to their children. I think part of the argument I suppose I have to make is that probably too many of them leave it too late and wait, and it becomes an inheritance, and actually some of that giving would be better made 15, 20 years before they died. Both in terms of the older person themselves and the beneficiary. Secondly, I suspect that people don't give as much as they think they do, but that's a personal sort of view. But I do also think that outside financial giving, it's very clear that, you know, I say very clear, that there's some fairly dodgy stats around older people being a very significant purchaser of sweets, of toys, of theme park tickets. Actually, older people, if they're not giving directly, often pay for this stuff. And I think it's worth remembering that. I think in terms of the sustainability argument, and perhaps I'll almost finish here. You know, our idea around an aging society New Deal is remarkably similar to a Green New Deal. It's if you look at the 10 things that you want from a Green New Deal, you probably want 8 of them in an aging society one. So I think what's really clear, and when we were doing this, we were really conscious that what we didn't want to be doing is saying older people should be buying rubbish. You know, actually we want to find ways of delivering the sorts of products and services that are much more sustainable and supporting, I suppose, the sort of world that both younger and older people want to see for the future. And so I think I just, the only other thing I haven't come back on, I think really, really interesting debate, and to thank my panels, the other panelists, is on the point around care. And I think I'd just come back and say, I think when we looked at this 10 years ago, care as a barrier to consumption was a much less significant issue. It didn't come up very much. I think that the work we've done most recently, the qualitative work we haven't yet published, suggests it is increasingly important. I think the thing that is surprising for me around is why this is important, given so many of us are in complete denial we will ever need care and don't think we'll ever have to pay for it. So I don't understand what, but I suspect it might well be that we get to a point in our 70s where the denial we've had in our 60s that we're ever going to need care changes, and all of a sudden we think actually we will have to save a bit more money. So I think that's all I want to say, except I think that it's very clear that around the sort of what actually no, let me finish with what's not very clear is of these 10 things we've set out, I think health is extraordinarily important barrier, but actually it is amazing that we don't really know the answer. We don't really know of those 10 things which is the most important, and it strikes me that yes, there is scope for research, but it is astonishing that the marketing, the business world has not got to the bottom of those 10 things and really worked out why spending for. So I will stop there.
Well, I just want to say, first of all, apologies again to everyone who asked a question and we didn't get round to answering it. Thank you so much for taking part, all of you who have attended this webinar today, but most of course, especially, thank you so much to our fantastic panel of speakers, to Isabel, Jenny and David, for your expertise and your wisdom and your points of view. Really, it's made for a fantastically informative webinar today, so thank you all. And of course, we also need to thank the Phoenix Group and the ILC Partners Programme for making this whole webinar possible. And let me just do a quick plug for members of our Partners Programme. They benefit from a range of opportunities, from business intelligence to networks and connections and wider brand benefits. So if you'd like to find out more about our Partners Programme, or are interested in becoming a partner, please do get in touch with our Head of Partnerships and Development, and Redvers Lee, and he's at redverslee@ilc.org.uk. And you can find all the ILC email addresses on the ILC website. This webinar today has been part of a weekly series that the ILC do on the impact of COVID-19 on an ageing population. And if you're interested in sponsoring one of these, please, then please do also get in touch with Redvers Lee. This year's Future of Ageing Conference is scheduled to happen on the 3rd of December, and we'll be exploring how we can ensure policy and practice work for today's as well as tomorrow's older and younger people. Confirmed speakers so far include Sir Jonathan Porritt and Vibal Cregan-Reid. So please make sure you can find out how to register at futureofaging.org.uk to make the most of the early bird prices. And finally, for news on our latest webinars and to stay up to date with all the ILC news, please visit our website, which is ilc.org.uk, and you can join the mailing list. And you can also follow us on Facebook and Twitter at ILC UK. I think that's it. Thank you again so much, all of you, for joining to our fantastic panel of speakers. And we really hope to welcome you at another ILC webinar or event in the very near future. Thank you and goodbye.
Thanks to David Sinclair for an excellent analysis.